It is Tuesday, the 6th of January. Good morning, everybody. On the agenda, Asian stocks surge again. Vera Rubin hype arrives early in Vegas, and Dr. Copper hits 13,000.
The markets then on the front foot once again. Asian markets set for a third consecutive day of record gains. MSCI Asia Pacific up 1.3%, led by the China tech story. European futures also pointing to the upside after gains of almost 0.9%, led by tech and defence yesterday, pointing out by 0.2. And Anna was saying copper punching through 13,000, up close to 3% in the session today. The countdown to the opening trade starts right now.
Tuesday morning, good morning. Asian tech, that's where the action is right now. Forget Las Vegas. Asian tech is the story. It is up again today. It continues to power higher, had decent momentum out of last year as well, and is continuing to deliver that. What is interesting, if you take a look at the charts, basically every morning it gets this kind of big leg higher. So basically money is pouring into this market in the early stages of the session, and there's definitely a reallocation element to all of this. People clearly are not looking at what is happening in the States. Nvidia barely moved overnight. Asian tech, Tom, has absolutely smashed it in 26.
Which rubs against what Andrew Sheets was saying yesterday, at least to some extent, in terms of this US trade is not going anywhere. Lean into tech, leaning to gains coming through for US equities. The view there from Andrew Sheets yesterday. But today it is all about that shift in terms of the valuation story as well. And in terms of the PE multiples, we're looking at about 15 from the MSCI Asia Pacific versus about 22 for the S&P 500. But one of our guests as well yesterday from UBS saying, look, there is a risk that US investors are overlooking the kind of gains coming through in the Kospi, in the South Korean memory makers, and that is an area to focus, even given the gains that we saw last year and the story in the momentum continues today. I think there probably is some read across from CS, because certainly Jen-Hsun Huang was not dampening the spirits when it comes to AI.
It's quite interesting the way that the market is managing, once again, as we've seen many times, to put aside the concerns around geopolitics and this full muscular expression of US power. Does that have a much more long-term play? Certainly in the short term, it's not doing much to change the agenda. Let's talk about CES then, Tom.
I think it was the pull forward when it comes to Jen-Hsun Huang in terms of the Vera Rubin chipset, the GPUs, the CPUs, the package, the networking, and also signalling that this is a year when it becomes about embedded AI, robotics, autonomous vehicles, and the complexity of computing that involves, and therefore the additional need and demand, and saying that there is very strong demand. And Lisa Su as well of AMD echoing that view that they continue to see solid demand from their customers.
Just back to that first point, these announcements normally come later. They normally come in the spring. Why has he brought it forward?
The rationale he gave is that simply there is that incredible demand from customers, that they are already seeing that increase in level in terms of complexity of computing. They need to articulate right now that these are in production. They've been in production, in the foundries. They have them in-house right now in Nvidia. They're ready to ship them in the second half.
Yes, so the announcement about the progress they're making coming earlier than expected. I was also drawn to the lines around China, because we know that the US administration, well, Trump has said he'll allow them to export those H200s, the slightly less powered equipment, to China, and it seems that Nvidia is saying they are getting good appetite for that product, which is not necessarily what we'd heard from Chinese officials. So that's an interesting dynamic.
And this is potentially a market worth between 50 to 56 billion.
Which they don't factor in at all.
Which they have not yet factored in. And when we talk about China, we think about copper. I mean, the Chinese economy is in a funk, and yet you see that copper punching through record highs.
But copper's weird at the moment. It's not. This isn't a normal market. Donald Trump has basically put tariffs in, hinted at further tariffs on refined products. All the copper's gone to America. There's not enough copper anywhere else. This is artificial. All markets, of course, are artificial, and we kind of change them on a daily basis. But he has significantly altered the landscape of this market, and as a result of which you're getting anomalies. There's a story on the terminal this morning. All the copper's locked in America. It doesn't want to go anywhere because everybody's worried about the fact that you could see these refined product tariffs being put on. So it stays there, and therefore we don't have enough. So that could be. It is abnormal. It's constructed, as you say. It's influenced by the policy, but it could have a real-world impact, couldn't it? If there is in the rest of the world going to be a lack of the stuff, then that's going to be something we'll watch. It is a lot about copper this morning. We'll talk about that later. But it's also worth noting that aluminium, zinc, both up by more than 2% in Asia. So
as if that ties into the risk-on trade as well as being about the supply concerns.
And it ties in the other factors as well. And you're right, it is predominantly the tariff story, it seems, and tariffs that they've signalled could be from 15 to 30%, but not until later. We'll get the details likely in June of this year as to how far they go on that story. But it ties in as well. One of the other catalysts is the electrification, is the data centres that comes back to the AI story, and that demand for copper.
Is it going to... It's a bit like silver. Is there going to be a moment soon where we get a kind of rebalancing? If America's got all the copper right now, do you get a kind of... Does the rest of the world basically refill the tank and therefore pretty soon it starts to even itself out?
Yeah, and do we see demand destruction on the back of higher prices? Goldman Sachs saying they're not seeing that in China, which is interesting given that's such a big market for the stuff right now. Let's tell you what is coming up on the programme in terms of our guest conversations. Peter Shafrick will go around the world with us, RBC global macro strategist. Lots to talk to him about as we embark on January 2026. Evie Hambro will be with us from BlackRock, head of thematic investing, obviously a person we turn to when we want to talk about a flight into precious metals and the rally we're seeing in the copper price. So lots to discuss there. Laura Cooper of Nuveen, macro credit head and global investment strategist. Lots to think about when it comes to the Asia tech rally. How does that sit up against the US rally in tech? And Mathieu Wiltz will be with us, JP Morgan co-CEO of EMEA. So many themes heading into 2026 ahead of Davos that we need to discuss in terms of the European and US banking sector.
And the focus today as well when it comes to geopolitics, the meeting, of course, between the Ukrainian leader, the President Zelensky, meeting with US and European leaders in Paris this morning, looking to get additional security guarantees or at least nail down some of the details and specificity around those details coming from the US. We're also going to get European and UK final PMIs this morning. We'll break those for you. 1 p.m. UK time, German inflation data drops. 1 p.m. UK time, the Fed's Barkin will be speaking, of course, as we think about the Fed's next steps in light of the jobs data that comes through this week. And, of course, it is CES in Vegas. We had the press conference from Jen-Hsun Huang yesterday. We detailed that for you. It really kicks off in earnest, though, over in Vegas today. And, of course, Ed Ludlow and team are on the ground bringing us those interviews.
Has Jen-Hsun set the tone? Is this going to be all about robotics? Like that feels like it is the narrative. That's where the emphasis is being placed. And
with the conversation with Siemens coming up later.
Yeah, so it'll be interesting to see how Siemens opens this morning.
Right, and that's probably something to do with robotics. There's also a big autonomous driving dynamic as well. We'll talk more about that later in the programme. Should we talk about shopping? I mean, Lizzie's not here. She's always enthusiastic in joining me in a conversation about shopping. But let's talk about next.
You're saying we don't?
Well, you know, I don't get quite the same vibe. Let's talk about what's going on when it comes. No, she just knows much more about it than I do. So, let's talk about next. Full year post-tax EPS is now seen at 7.38. This is pence per share. They had seen it at 7.29, and the estimate was 7.30. So it's ahead of the estimate, and it's ahead of the previous guidance. So this is quite, on the face of it, looks to be quite a bullish new forecast coming through from a bellwether within the retail space.
So what is interesting is that a lot of the analyst notes, and Barclays in particular was out with a note before Christmas saying it expects cautious Christmas trading. The update to be cautious. Actually, that was yesterday, but pointing to the period before Christmas. So I think the market is going to be quite surprised by this, judging by the analyst notes that are out there, that Next is sounding as positive it is. Because everybody was expecting consumer doom and gloom around the Christmas period. Next is disproving that.
Yes, indeed. So if those lines drop into a market that had been expecting something more negative, then maybe we see a pop in Next.
And as we talk about the doom and gloom that maybe is not coming through, at least in the next numbers, the inflation data, at least food price inflation data that we got out into the survey overnight suggesting that remains a problem for the UK, ticking up higher than expected. But there has been a move down when it comes to the grocers into the lower and cheaper, the Aldis and the Lidls.
The value range
benefiting. At least when it comes to food and grocers in the UK.
But it's interesting. I was talking to Neil Kapling over on the markets desk a little earlier. He's come back from Florida. He says, gas is really cheap, gasoline's really cheap, but groceries are still super expensive. So it's a similar narrative. We don't get the cheap gasoline here. That's something we don't have because they tax it all. Anyway, what else do you need to know this, Tuesday morning? Delcy Rodríguez has been sworn in as acting president of Venezuela after the capture of Nicolás Maduro by American forces. The government in Caracas has been reasserting itself with paramilitary forces reportedly patrolling the streets. Meanwhile, in a New York court, Nicolás Maduro pleaded not guilty to narco-terrorism charges. The US has accused Maduro over the weekend of using his position in government for a quarter of a century to A, enrich himself, and B, help transport cocaine into the United States. Denmark's Prime Minister claims the NATO alliance would end if the United States were to attack Greenland. Mette Frederiksen says Donald Trump should be taken seriously when he says he wants Greenland, and that Danish officials are on alert after the raid on Caracas over the weekend. President Trump seemed to put a 2-month timeline on when his attention would turn to Greenland in comments to reporters. And freezing temperatures are pushing up French power demand and prices, with a 24-hour strike by Electricité de France workers, which started last night, expected to tighten the market further. The latest industrial action comes as cold weather has lifted electricity consumption to the highest in 5 years, as people apparently turn up their heating. It's cold outside.
It is cold outside. That's news.
It is.
Yes, you can rely on us for that.
Look out of the window. There's your news.
The Dutch railway provider saying there are no trains on Tuesday morning. That is just one snapshot of the chaos being caused in some parts of Europe by this weather. Coming up on the programme, we discuss where the global defence narrative is headed amid growing geopolitical tensions and fluctuating share prices. Of course, the focus on Ukraine, but with the backdrop being Venezuela, Greenland, all of the developments over the weekend on that front. Plus, drinks maker AB Inbev reacquires its stake in a US container plant for $3 billion. We'll watch that stock at the open. Is there a link into some of the basic metals stories we've been covering this morning? And up next, Asian equities hit a record led by Chinese technology shares. We will talk markets. If you have any questions for our guests, please do get in touch. IB plus BBTV Go. That's the function to use to get in touch with the team that puts together this programme. This is Bloomberg. Welcome back, everybody. This is the opening trade, Tuesday the 6th of January, and 45 minutes until we get the start of equity trading. And it looks as if the positivity that we've seen, well, through global markets, through the Asian session yesterday into the US, through the Asian session today, is looking to come to Europe once again, and we are called just a little bit higher at the start of trade. Let's talk about what is going on in these Asian markets. Then they continue their strong start to the year. Let's bring in Bloomberg's Valerie Teitel, who has her analysis for us this morning. Val, good morning to you. So your thoughts on another day of AI tech surging?
Yeah, I think this is telling us this is not just another year where you close your eyes and buy the NASDAQ or close your eyes and buy Nvidia. There is some real pickiness going on here, and I think that's the reason why we're seeing Asian stocks really surging to start the year. The Kospi is up 7% in the last 3 sessions. The NASDAQ is essentially flat compared to that. Likes of Samsung in the last 3 sessions up 15%. Nvidia closed in the red yesterday. I think that's really telling you that investors are looking for value here. I mean, Asian tech trades at a discount to Nvidia's multiples. And again, a lot of it is weighted towards the memory chip sector, which I think the investors are keenly focused on because of the possibility of a supply shortage this year.
What does the price action tell us about whether or not this is a short-term trend or something more substantial in terms of money flows into Asia and maybe at the cost of US, as you mentioned?
Well, I do think it does tell us that maybe investors went into this year under-positioned tech because of the wobbles that we saw in the NASDAQ in October, in November, and in December that might have had people a bit under-allocated as they started the year. I think it's also telling you that the investors are more looking upstream in the supply chain here. They're looking, again, at chips instead of software, the likes of AI agents and software. They're instead looking still at the chip makers. Again, a part of that story is also industrial metals. They're looking for really where the bottlenecks could be this year. And I think that's another reason why we're seeing copper again. Silver have a good, strong start to the year. Yep. Again, that's the discussion around bottlenecks in this trade. And again, investors perhaps just underpositioned these alternatives.
It's amazing the momentum came out of last year into this year. Asia with the momentum, European and US markets, not so much. Valerie, nice. Thank you very much indeed. Valerie Teitel on what we are seeing. Let's get another take on what is happening here. Another day of gains. Chinese tech shares doing really well. The Kospi's doing really well. Currency markets also on the move in Asia too. Peter Shaffer, global macro strategist at RBC Capital Markets, joining us around the table. You can't close your eyes and buy the NASDAQ. You've got to be more selective. You've got to look at value in Asia. Is that the message that you're getting at the beginning of this year?
Well, I think there's a whole range of things going on at the same time. One is, and that went through at the end of last year, we're not really seeing the weakness in the US coming through, so that gives basically people a green light to buy risk generally. But then, as you say, diversification is also a theme, and particularly into Asia. And as you mentioned, the currencies, one of the other things that's very clear in the Asian markets, not only the valuations in the risky assets look cheap, it's also the currency looks relatively cheap. So it looks like this is certainly a good angle for diversification for international investors.
Okay, it's diversification. So over the last few years, diversification has meant I've underperformed. Is diversification now flipped on its head? Diversification means I'm going to outperform. I've underperformed US markets if I diversified because of the big tech surge. Has that now changed? Has that been flipped on its head?
Well, I think that's certainly the message that we are getting from a lot of clients that we're speaking to. The overinvestment or the perceived overinvestment in the US is seen to be at least as a risk, and therefore it seems to be the better hedge to put money either elsewhere or at the very least put some kind of a currency hedge in place. And that's what we're seeing playing out, I think, at least in the dollar, but we're also seeing in these other assets that we just discussed.
Peter, good morning.
Good morning.
What are you watching in all of the geopolitical headlines that we are bombarded with since the start of this year, certainly, on a different front? What do you look at there to inform you whether this is going to have any relevance for global risk appetite? Because on the one hand, you'd think this sort of overt projection of US power, as it's described on one blog yesterday, would have some impact. It's just working out what that impact would be. Could even be a positive one, I don't know. But what are you watching to see if there's any link?
Yeah, so I think we have to be very, very careful between the near term and then the medium term potential impacts. And the near term, when you look at it, markets are always very quick to say, all right, it means like all of a sudden there's going to be an oil glut. Well, no, probably not. So when you look through these things, you'll find, well, the near-term impact is probably limited, and that's sort of what we've seen. The medium-term one is one we'll have to see how that works out, because as you say, is it a positive, is it a negative impact? That's very unclear at this stage, and I think one of the implications that you're seeing is that the typical sort of risk hedges like like gold or silver or something like that, that's performing, and I think that seems to be the clearest near-term takeaway from that.
Yeah, and do you take risk on messages from what we're seeing in the metals? I mean, as Guy was saying at the beginning of the programme, is that there's obviously the tariff conversation, there's a lot of politics in there, and there's some outages, large swathes of the global supply not providing what it should. But do you also take risk on messages from that kind of surge in copper price?
I think maybe a tiny bit, but in my mind that's not the main story. But first of all, when you look at when you take the complex apart, I mean, there's the precious metals, they're searching for a different reason, and then, you know, as Guy was saying earlier, there's probably sort of some idiosyncratic factors in the copper market in particular. But I mean, clearly one of the things, going back to the very first question, that we're seeing is coming out of 25, going into 26, that the doom and gloom that at one point prevailed, that's giving way to a more optimistic global narrative, and that's helping things such as copper as well.
Peter, what did you make in terms of the bullishness of the comments that we heard from Jen-Hsun Huang yesterday on the pull forward of the details for their latest chipset? How bullish a signal is that potentially?
I mean, I think from a macro point of view, you just see continued investment in the complex. And as long as that's the case, that's driving, in particular the US, but probably other markets as well. So in my mind, that's from a macro point of view, that's the signal that we're getting. There's continuously investment in the complex.
Does that investment become a European story in 2026?
Well, we'll have to see. That's the big question. Certainly, we see more drive towards that. We heard from many corporates that this is the direction that they want to go. But then, as we've seen with the Europeans, we'll have to see the hard numbers before you start believing it, and certainly before the market starts believing it.
Well, put this all together for me. What is the picture that is emerging in 2026, and how different is that picture to what 2025 looked like? Can I carry on the same playbook that I had last year, or do I need a different one for 2026?
Well, I think if we look at the playbook for 25, it moved quite a lot, because in the early part of the year, after the tariffs and Liberation Day and all of that, there was, as I was just saying, there was a lot of doom and gloom. That gave way towards the end of 25. I think that's the playbook that we probably can continue, at least for the time being, where we see more optimism that the US won't go into a recession, that the labor market is probably not going to weaken. We'll see what the figures are going to bring on Friday. And that the investment is going to stay in place, and that over here in Europe, we'll probably also see a slightly better picture. So that's the narrative that we can continue for the time being.
But if we reach the point where credit spreads in America are so tight that they can't get much tighter. Valuations on equities are so high that they can't get much higher, that multiples can't expand that much further. Have we almost exhausted those trades? And the Asian trade this morning kind of speaks to the idea that we need new ones. And yes, it's diversification, but it's also just a kind of, we've done that, can't push it much further, need something else to push harder.
Well, I think when we think about the valuation, that might be true. But then when you think about sort of the underlying drivers, even if you don't have multiple expansion, can you have an environment where corporate profits still growing? Yes, you can. That's positive. Can you have an environment where other parts of the world sort of start catching up with where the US is? That's going to lift all boats. Yes, you can. So I think from that point of view, it might not be the exact same playbook as you were describing earlier, but it's still a relatively positive story. And I think that's the takeover from 25 into 26.
Yeah, and what about the FX markets in that context then? Because there were two halves to the dollar story, certainly, and that was a real global influence. So the first half of last year was very much about the weaker dollar, around concern around tariffs and many of the other concerns around fiat currencies that we talked about and debt levels. But then the second half of the year, the dollar indexes were pretty flat, really.
Yes.
So where does that narrative take us? That seems as if it's paused, waiting for its next direction.
So first of all, what we would say, going back to an earlier question, is when you look for individual strength, I think it's probably going to be in Asia. So the Asian currency complex is probably going to do quite well. We've now seen CNY, for instance, being fixed below 7. So there's an indication there, and some of the other currencies in the regions are doing quite well. And we're certainly proponents of Asian currency strength. When you look at sort of the more Western complex, I find it very hard to see a story that argues for individual strength, let's say, out of our European time zone here. That will probably remain a dollar story. And we probably think, because of the diversification we talked about earlier, that over time the dollar is probably still going to weaken somewhat. That's in the interest of the US trade policy as well. And as a consequence, we probably see euro-dollar higher, but it's not necessarily, in our mind, a strong European story.
And so maybe driven by weaker Asia rather than much movement in the European story, then?
You mean stronger Asia?
Stronger Asia, weaker dollar.
Stronger Asia, weaker dollar, but not necessarily European idiosyncratic story.
I mean, to Anna's point, dollar weakness in the first half of last year, euro strength, and that was a headwind for the European earnings story. And you see further upside for euro dollar. So how much of that is a constraint on the European earnings picture for this year?
I mean, as long as we don't really jump significantly higher, I don't think it's necessarily going to be a huge problem. And we certainly don't see the pushback coming, let's say, from the likes of the ECB at the moment. And particularly if it is counterbalanced by, let's say, weaker energy prices, which would be a boon for the Europeans. I don't necessarily think that a slightly stronger euro, let's say, is going to be a major problem.
Okay. Peter Shafrick, thank you very much indeed. Global macro strategist at RBC Capital Markets, doing a bit of a global tour for us on Asian currencies, the euro dollar, and of course the AI theme, and how to think about diversifying into the Asia piece of that story as we see further strong gains coming through for Asia this morning, of course. Coming up, we're going to get to the industrial metals space. Dr. Copper's red-hot rally, breaking above 13,000 per tonne for the first time, a fresh record at least for copper. We're going to discuss the surge in prices with BlackRock's Evie Hambro. We'll get Evie's view on the industrial metals space, but also, of course, on precious metals. Gold and silver, with silver outperforming gold in the session today. Stay with us for that conversation. It's coming up. This is Bloomberg. We are 30 minutes from the start of the opening trade. This is Tuesday. European futures actually fading some of the gains. There was strength, of course, yesterday in the session, gains of close to 1% across European stocks. Futures just eking out some upside, and it's been a very strong session in Asia. But again, the European futures picture fading somewhat after the gains of yesterday. The 50 futures, as you can see, just up, just shy of 0.1%. Here in the UK, FTSE 100 futures are looking at a brighter session, pointing to gains of 35 points. And CAC 40 futures over in France as we ate some data out of France, pointing higher by just 8 points. points so far.
We'll get the data in a minute.
Yeah.
French CPI preliminary data about to arrive on the Bloomberg terminal, I think, at 45 minutes past the hour. The bond market beginning to open up a little bit. On offer at the moment, yields a touch higher, not by much, but a little bit higher this morning across Europe. We'll keep an eye on what is happening there. It doesn't seem to be the focus. Asian bond markets have actually been quite interesting. European ones, I think, a fairly quiet start to the year. I just want to draw your attention to what else is happening in France right now. Mark Carney, the Canadian Prime Minister, is due to arrive in a very dark and cold Paris. That certainly is the picture that we have in front of us, the Élysée Palace, where he will be welcomed very, very shortly. Obviously, the big focus over the next 24 hours will be the ongoing talks surrounding what is happening in Ukraine. But we'll keep an eye on those live pictures. It does look a little chilly.
It is chilly, yes, in Paris, and no doubt of interest to Mark Carney and all Canadians what's happening in the metals prices. So let's go there next, shall we? Copper is extending its rally after hitting $13,000 a tonne for the first time as investors bet on a tighter market. Supplies are being shipped to the US amid a lack of clarity over future metals tariffs, potentially leaving the rest of the world short. Let's bring into the conversation Evie Hambro, Global Head of Thematic and Sector Investing at BlackRock. Very nice to see you, Evie. Happy New Year to you. It's not too late. It's not too late on the 6th of January, is it? Let's talk about copper first, because that seems to be overnight where a lot of the excitement and the action is, over 13,000. You point out that 7% of the world's copper production was offline by the end of 2025. So this is a market that is not getting all of the supply that it had banked on, I suppose. That's part of the narrative. But is the tariff story just the big story for metals?
Yeah, well, Happy New Year to you as well. So, I mean, I've been on the show a bit over the years, and I've been probably accused of being a kind of stuck record saying the same story, which is, we've got a lot of factors that are at play in commodity markets, and sometimes it takes a while for people to recognize those. When they start to play out, individual ones can become topical. But to me, it's about supply and demand. And the supply and demand picture has been kind of slowly building to this picture of, reduced oversupply and going into deficits, and some of that's been accelerated or pulled forward by the production issues that happened last year. That really kind of increased interest. I think then you've got the prospect of these tariffs coming back in the middle of this year, or during the summer of this year. And if that plays out combined with the very, very strong fundamentals, then you have the makings of a very exciting market.
If we didn't have the tariff story to think about, because there's some complexity about how the tariffs will apply in the future or not, if we didn't have that, where would copper prices be? Is it possible to have a sense of that? Because maybe it is just a sideshow and actually we dedicate too much time to thinking about it, and the fundamental story is really what matters.
Yeah, to me it's always the fundamental story. I think the other stuff is relatively short term. I mean, last summer we had tariff threats and prices spiked to crazy to very, very substantial levels very, very quickly, and everyone was focused on that, and then that news disappeared and they came back to the fundamentals. So to me it's always about the fundamentals, and I think last time I was on we were talking about silver, and we were talking about the problems in the silver market and all of that, and so on. So these things come and go, and to me it's just you've got to get back to that fundamentals. That's what gives you the kind of the foundation of making any investment decisions.
It's interesting at a time when the Chinese economy is obviously struggling in terms of the demand picture, and of course the rewiring of the renewable energies kind of impulse in the US as a result of the Trump administration, because those are two factors that could be supportive as well, but they're not really at play. In terms of that demand story, how is that evolving when it comes to copper? Yeah,
so the demand story is interesting. You mentioned China. Yeah, China's going through an evolution of its economy. Everybody going back 15 years ago, if property prices are going up in China, commodity markets went up. Today, property prices for the last since 2015, 2016 have not been going up. Yet copper markets have been improving, and I think it's that transition inside the Chinese economy away from the property markets to more industrial activity. You look at the things that China's investing in today. It's about the power infrastructure. It's about AI. It's about electric vehicles. It's not about the property that's driving the commodity markets there. It's about the industrial activity that's doing it. And I think to still be looking back at that as your reference point and linking it to commodities, you're kind of missing part of the picture. And I think you then take that and you roll it out globally, and it's the same thing. It's happening in a variety of different economies. So it's happening in Europe, it's happening in the US. So we're seeing this kind of industrial activity. We're seeing this move away from fossil fuels towards kind of renewable power. We're seeing this increased electrification. We're seeing AI. We're seeing all of these pressures building, and they need commodities to solve them.
Is the message inflation? is that the other thing we should look at here? Is the message Dr. Copper is telling us, sending us, that we are going to be seeing higher prices?
Well, we are seeing higher prices in commodity markets, in metals markets. We're not seeing them in oil.
Does that spread out more broadly across the entire economy? Is it inflation in industrial metals? Does it stay with industrial metals? Or does everything I buy just get more expensive?
Well, I think everything you are buying gets more expensive because currencies are being devalued, as we've spoken about in precious metals conversations. So to me, that's the kind of the big trend out there, is paper currencies are losing purchasing power. And does that then translate into inflation? Well, there are going to be some offsetting factors. Oil prices don't look like they're going to go up much from here. Okay,
it feels like you're telling me that I should be moving on and talking about gold and silver. So hold that thought, and we'll come back to it in just a moment, because another factor which is driving that story as well is what is happening on the geopolitical front. Delcy Rodríguez has been sworn in acting president of Venezuela after the capture of Nicolás Maduro. While in a New York court, Maduro has pleaded not guilty to narco-terrorism charges. John Herskovich joins us now to talk about this. John, just give us an update on what is happening in Venezuela. Do we have a better picture now on how the country is going to be run, and how different will it be from what came before?
Sure. We have the new president, the acting president, Delcy Rodríguez. The vice president of Maduro is now the president. And what we're seeing now is a continuation of the previous government without Maduro. It's a government that's going to be using repression as it did previously and not looking at reform. The Maduro loyalists are still in the key positions. They're in the National Assembly, they're running the courts, they run the military, the intelligence services, and the state oil company. So we see that continuity on one side. The Trump government seems to be pushing for this type of is looking at coercion as opposed to occupation. So we're seeing this is the situation on the ground in Venezuela, and it'll probably be this way for several months. There's no indication that elections are coming soon.
Yes, okay, so as we try letting the dust settle, it seems, or trying to gather all the information about how US influence, if that's the right word, will operate there. Meanwhile, in the US then, John, Nicolás Maduro had his first day in court, and there's a lot of focus on what happens with the energy sector. President Trump suggesting the US may subsidize energy companies' investments in Venezuela and its oil industry. Did we get any detail? Certainly Chevron share price went higher, but any detail on what's really happening with the oil businesses?
Yeah, we're getting a lot with the oil, with the political situation. We're getting a lot of bold statement, but not a lot of details. Trump is seeing that we could see an increase in production in the next 18 months. We don't know what companies are going to go in there. Bloomberg reported previously that it could take 10 years, $100 billion to rebuild Venezuela's oil sector, which is in disrepair. We don't have any companies stepping forward and saying we want to invest, we're going to be there. Chevron is already there, but apart from Chevron, the major U.S. oil companies aren't stepping up. Trump administration says they're going to talk to them, but we don't have the investment. With oil, relatively low prices compared to the past few years, it doesn't seem like companies are going to be jumping into Venezuelan oil anytime soon.
John, thanks for the update. Really appreciate the insight as to what is happening. John Herskovich joining us on what the latest is on Venezuela, which takes us back to the gold and silver trade. People are buying, it seems, on the geopolitical risk that seems to increase, Evie, day by day. Yeah. Does it keep the trade going? Do I keep buying gold on the idea that actually the world is likely to become a more fragmented and more dangerous place?
I think it's just, without repeating myself, it's another factor. Right. The geopolitics, was everyone expecting this to happen? I guess no. And it's just another thing that's been put into the mix. But to me, it's going back to gold is about the loss of purchasing power in paper currencies. This trend has been going on for decades, and it's going to carry on for decades, probably at an accelerated rate. And I think when we were last speaking about this, to me, it's catch-up. Gold is catching up with where it was in terms of purchasing power to where it should be. We're in this move right now, higher than where we are today. That's the simple answer that you probably want. I'm not going to give you an absolute number.
He wants one with more numbers in it.
Exactly. But, I mean, we were speaking about silver last time, and there was, oh, my God, we got to fly this silver from London to New York to solve the issues with regards to the futures contracts. And I think silver was kind of trying to get to 50. We're at mid-70s today. So, what's driven that? Was it that specific event, or was it the underlying fundamentals in the market? And you've got to always keep coming back to these fundamentals, because that's going to give you the kind of foundation. But for us, as equity investors, these are going to be really, really exciting times. These companies are going to be making a lot of money now. You've got similar levels of profitability in terms of percentage for gold companies today. So they've got 50% kind of margins, or a bit more than that. But, they're producing the same amount of ounces, and if that's a $2,000 margin, these companies are going to be generating an enormous amount of free cash flow. And as we've spoken about in previous shows, these companies have all delevered. The cash is surplus to requirements, and it's going to come back to the investors. And with these companies trading on very, very low multiples, the lowest I've seen in my career across most of these commodity markets. And even aluminium is going, crazy at the moment. So, the whole thing is very exciting, and it's a little bit like we were really, really topical, and everyone was excited, and there was loads of coverage in the early 2000s, the China trade. Today we're in a different environment, and it's kind of momentum's coming back, and we could just be at the start of this.
These producers are trading at the lowest multiples that you've seen in your career, despite the run-up that we've seen in gold and silver. What are investors not seeing that you're seeing, and when do you expect that to change? Is that the clearest play right now? It's through the producers versus direct exposure?
Well, we always invest in the company, so I'm probably a bit biased in terms of what I would say, because to me, you're likely to get that extra return from investing in a company rather than just the metal itself or a futures contract on a commodity, because you've got the chances of growth and dividends and M&A and all of those things, but you've got risk attached to that. So a diversified solution on the equity exposure should deliver a superior outcome through time. So that's our preference, but I wouldn't say don't have the metals exposure. A bit of both is probably the ultimate way to get the mix.
And so every time we think about the cycles within this sector, we think about investment, and it takes a long time, these projects, to invest in them, and
longer and longer,
longer and longer, which is interesting in itself, isn't it? So are you concerned at this point about overinvestment in this cycle, or no? Just given the way that the prices are moving, not at all, because that has been a concern in the past.
Absolutely, and it's something that we've always watched for. Kind of reckless capital allocation destroys value for investors and for all stakeholders, governments, societies, and so on. So we're very, very focused on that. We're not seeing signs of a pickup in investment across the space. There are projects that are kind of being dusted off. The files are being pulled off the shelves, and they're having a look at them, saying, "Does this now work at $13,000 copper?" I doubt anyone's using that in their models, because we've only just got there. But does it work at $5 a pound, somewhere around there? Having a look at that. Well, the capital cost has gone up a lot, so it might have worked on the old capital cost number at $5 a pound price, but when you shove in the updated numbers, which are probably 30-40% higher than they were when you did the original studies, it's like, oh my God, the return is just not there. And then you've got all of the risks attached to building it in terms of the time frames, the cost escalation, what governments are doing. Governments are out there asking for more. They want a bigger slice of the action, and we're seeing that as a trend globally. So that's a risk you've got to take in. So you might get your return, but if the government comes along and takes away a chunk of it, your investors aren't going to be very happy. So to me, there's quite a few factors out there kind of restraining enthusiasm to invest in new capacity.
Is there any standout stock stories, or do I just buy a basket?
There are some standout stock stories, absolutely. There are companies out there that are completely smashing it. We've got some really great investments across the portfolio. There's probably not enough time to go into detail on the individual names.
Give me a few if you have a moment. But is that the way to trade it? Do I have to... I'm going to get alpha if I find the specific companies, but I can get a really decent return if I just buy a basket. I'm just wondering how people watching the show, how should they be thinking about this trade?
Well, if you look at the gold market last year, gold prices were up 60% or something last year. Most gold funds, ourselves included, were up 170, 180% for the year. That's quite a lot of alpha relative to world markets, up 20. The broader commodity mix, the funds were up 70% for the year versus world markets. I would never say that the numbers from last year are repeatable. There's lots of health warnings around that. But if you look at the potential for the underlying companies, a flat commodity price market for 2026 will allow the companies to earn into these prices and probably improve their multiples. Right now, I reckon there's a bit of caution from investors saying, commodity markets have run hard in 2025. We need to see where commodity prices kind of settle down, and if they settle down at around these prices, and we were looking for lower levels than where we are in today's market for them to settle down to, then they'll earn into that. And as they earn into that, that's great for equity returns.
Evie Hambro, thank you very much indeed. Global Head of Thematic and Sector Investing at BlackRock. Guy Johnson raising the prospect of inflation as a result of higher commodity prices. Let's get you an update right now on the inflation picture in France then. French CPI month on month for the month of December coming in. Month on month, this is the CPI number, 0.1%, a little softer than the survey of an increase of 0.2%. Year on year, CPI out of France for the month of December coming in also a little softer than the survey, marginally so. 0.8% is the year on year move higher versus a survey number of 0.9%. Harmonised, we're looking at year-on-year inflation in line with the survey for inflation out of France. We've got more data, of course, through the day and through the week on Eurozone inflation as the debate continues as to what the next move is for the ECB, not expected to move this year.
Bloomberg Economics talking before this about the possibility of really negative inflation dynamics coming through in Europe and talking about the Chinese export story and how that's going to perhaps weigh on prices in Europe. So, we'll put a pin in that ECB conversation, perhaps.
Oh, yeah, definitely going to come back to that one. What are we going to come back to next? Coming up, more good news from Nvidia.
And if Vera Rubin is going to be in time for this year, it must be in production by now. And so today I can tell you that Vera Rubin is in full production.
Can't work out the robot's the more exciting thing on stage, or that jacket that Jen-Hsun Huang was wearing. Quite incredible. Anyway, we'll talk about the chip stocks ahead of the European Open. That's next. This is Bloomberg.
Welcome back. This is the opening trade. Joining us now, Bloomberg Markets Live, Skylar Montgomery, Koning with thoughts on these markets in 3 minutes. Very good morning to you, Skylar. So just minutes away then from the start of the European Equity Trading Day. We've spent a lot of time talking about being excited about the Asia tech trade. Does that excite you looking ahead, or is it all about US stocks once again?
I mean, I think it's all of those things combined, but the number one thing I'm looking at for 2026 in the equity outlook is growth. Now, I find it really interesting that if you think about consensus estimates for this year, it's for 9%, which on the surface is quite good. It's in line with the historic average, but I think it's actually relatively cautious when you think about the growth context for equities. So what you tend to see is that there's this wide dispersion within returns in the equity market, where if growth is strong, you get very positive returns. So the average positive year is actually up 17%. So last year was actually in line with that. It wasn't totally off-piste in terms of being strong, whereas in years where growth is negative or recessionary, you have negative returns. So if you expect growth to hold up this year, which I think most people do, we have monetary ease that's still feeding into the pipeline in terms of growth. You have fiscal ease as well in terms of extensionary policy out of the U.S., then you should expect returns to be higher than 10%, which happens 60% of the time. So you should have a more kind of bullish bias than I think what consensus has.
If I'm a European investor, if I was a European investor last year, the dollar killed my performance in the States. Similar story this year?
I don't think it's quite the same. I think also the relationship between equity markets and FX shifts, right? So it depends on what is your cost, what is your output. I think particularly for the dollar this year, you're not thinking so much about downside as we were last year. And again, returning to consensus numbers, what's interesting is consensus is expecting dollar downside versus the euro again this year. Consensus has expected dollar downside versus the euro for the past 9 years. And it's only happened less than 50% of the time.
Bit of catch-up being played maybe then.
Yeah, I mean, a bit of catch-up being played there. I think, too, as we look into this year, particularly at the beginning of the year, positioning has shifted very long the euro. So at the end of 2025, you had asset managers as well as leverage funds being quite long, and particularly leverage funds. That net long is comparable to the level that we had in 2018. That's the last time it's been this high. And that peak in positioning was also the peak that you saw in the euro traded weighted index, which then traded down for 2 years in fits and starts starts through the latter half of Trump's term.
Yes.
So that's a worrying comparison as we start the year, particularly if you're bullish the euro, as consensus is.
Euro's vulnerable, and you're looking potentially at a 2-year horizon for euro weakness, or more modest?
I think considerably over the next year or so,
right.
You can definitely think about euro downside. I think it's partly a catch-up trade. I think it's partly, how much more bullishness can you really price into the euro relative to growth, relative to central bank expectations, but also there wasn't a big reason for dollar downside last year other than hedging ratios rising, and those have now normalized. So that's something to consider both near-term and long-term.
Okay, fantastic. Bloomberg M Live's Skylar Montgomery-Koenig, thank you. Let's get your stocks to watch now with Chloe Melly. Chloe.
Good morning, Tom. Mining is in focus today, of course, with gold and silver continuing their rally because of geopolitical tensions, of course, and also copper hitting new records because of tightening supply in that market. We have seen all of those names up here on the board moving higher yesterday. That's likely to continue again today. Moving on to AB InBev, which is reacquiring a stake that it had sold back in 2020 in U.S. metal container plants. It's reacquiring it for about $3 billion. So we'll see how the market reacts to that after what has been quite an uneven performance over the last year for AB InBev. And finally, food inflation is ticking back up in the UK for the first time since August. That is likely to put pressure on consumers and potentially push them back towards cheaper retailers. So let's see how those big UK supermarkets, Tesco, Sainsbury's and M&S react to that this morning.
Chloe, thank you very much. Chloe Melly with us there from the equities team, of course, with a look at some of the stocks that could be on the move. We will keep our focus on tech, perhaps. Asia Tech has been in focus for us. So ASML could be in focus. Not a hugely accurate read across in these global, between one geography and tech and another. Yeah,
it was a clearer read across yesterday, of course, and ASML was one of the strongest gainers on the back of the upgrade coming through from TSMC. But the overall bullish sentiments come through from the likes of AMD CEO, the CEO Jen-Hsun Huang, of course, of Nvidia as well, could be supportive for tech once again. Coming up, the open trade, of course, futures pointing to modest gains. Stay with us. This is Bloomberg.
The S&P was so 2025. Asian markets, Asian tech, that's the story for 2026. But we'll start off and talk a little bit about what the S&P delivered yesterday. This is where Europe went out. That's where the S&P finished yesterday. It rolled over in towards the end of the session. Asian tech overnight has absolutely smashed it. The numbers being delivered in markets like the Kospi are eye-watering. Can it continue? I don't know. But it's certainly putting the S&P in the shade at the moment. And to a certain extent, Tom, Europe as well.
European stocks yesterday, very strong performance, of course. But to your point, European futures right now, a little bit lackluster. There were stronger signs coming through at the early part of the morning, but today and right now, as you look at the futures picture across the benchmark 50, currently flat, slightly brighter picture when it comes to the UK. FTSE 100 futures looking to add 28 points. Of course, the outperformance last year as well. The CAC current looking to add just 3 points. It's a little bit soft as well when it comes to French futures. Very, very modest gains flagged as we lead up, of course, to the open.
Yes, Tom, let's have a look at some of the individual stocks and sectors in focus. Certainly, AB InBev will be one we'll be watching. They're going to reacquire a just shy of 50% stake in its US metal container plant from a consortium of institutional investors. They sold it back in 2020. They're reacquiring it. Does this have to do with the metals trade, the import tariffs, the risks associated with all of that? That takes us on to mining, where we'll certainly watch the mining names, because copper has surged to a fresh record, $13,000 a tonne in yesterday's session, continues to motor higher today. We're watching the tariff story, but also, as Evie Hambro is telling us from BlackRock, watch the fundamental demand story around data centres, electrification and all of the rest. And what's next as well, this bellwether of the UK high street lifting its profit forecast again on strong holiday season sales. Will that be all down to their delivery, or is that about the sector? Guy?
We're going to watch that one very carefully. Siemens maybe another name that we're going to watch as well into the market open here in Europe, which is now upon us. Tuesday session is underway. Let's take a look at some numbers and give you an idea of what is happening. We are expecting it to be a little positive, not a lot positive, but a little positive. Certainly not as positive as we've seen out of Asia, but not a bad performance. Again, we're up 0.1%, 0.2% for the FTSE 100. A few minors in there. Defence stocks yesterday was the narrative. Will be the narrative today. We'll find out in just a second. The CAC current inflation coming in line with expectations. Over in Paris. The IBEX, the outperformer last year, up by 0.2% so far, but the FTSE 100 appears to be the outperformer. Let's find out why. Tom Mackenzie, what's happening in sectors?
on the sector basis right now, basic resources unsurprisingly at the top of the list. Gains of a little over 1%, given, of course, the record pricing coming through from copper, but other commodities as well in focus. You're seeing silver, of course, higher, pretty significantly up more than 2% so far in the session. So basic resources is once again powering ahead, top of the list. Energy following with gains of 0.9%. Retail on the back of the strength coming through from Next. And we have a read across, of course, to other retailers in the UK. Retail as a sector up 0.4%. On the downside, consumer products a little softer by 0.4. You've got 4 sectors so far in negative territory. Tech, interestingly, down 0.1%. We'll see how that adjusts, though, as the other major indexes start to print.
Yeah, it was interesting, the basic resource trade, because, yes, we talked a lot about copper, we talked about gold and silver, and we see some of the silver miners going higher today, some of those names linked to copper, but it was actually a broader surge in metals overnight in the Asia trade, so aluminium, aluminum and others also going higher. So we'll continue to focus on that. Also interesting that energy is up by 1%. Yesterday, this time yesterday, we were talking about oil prices being a little bit weaker on the Venezuela story. Then we saw a surge 1.7% higher by the close in the oil price. And so maybe there's a little bit of catch-up, the likes of BP and others trading up by 1.7% this morning.
Novo's up, which is interesting. Talk about price war yesterday in the States. Maybe that's giving that a lift. I want to look into that a little bit more. Some of the banks are doing well. The energy names are up. But on the downside, SAP, the software story, that's interesting.
And we've seen that divergence. And it's something we have a terminal chart showing the divergence between the software names in the US and the chip makers. You're seeing that now reflected in the European session. SAP under pressure. ST Micro gaining 2.6%. So the chip makers performing
Chips go one way, software goes the other way.
Yeah. Is that a theme that continues in 2026? Let's get more and bring in Laura Cooper right now, global investment strategist and head of macro credit at Nuveen. And we've been talking and obsessing about the gains coming through from Asia. What does that tell you? To what extent is that a sustained theme for this year, a reawakening of the animal spirits in the Asian session?
Perhaps that is the case. I think what we're seeing is this AI exuberance that largely dominated 2025 carrying into 2026, and I suspect that's going to continue to be that dominant story looking for the year ahead. But I don't think that's necessarily going to be concentrated in Asia. Yes, there are some components of that suggest investors want diversification from that concentration risk in U.S. tech, but looking at earnings backdrops, looking at the capital expenditure plans, we really think this is a backdrop where you don't want to bet against the U.S. and in particular that AI trade still leaning into the U.S. large caps, but selectively.
Selectively, still leaning in. So there is a lot of kind of mirroring of the 2025 story when it comes to your view on AI then. How does that differentiate through 2026? How selective do you need to be? And to what extent can the hyperscalers continue to reward in terms of returns?
Well, I think the story last year was this AI enthusiasm, really a catch-all. We saw the technology sector and kind of second-order effects of AI really being beneficiaries. But I think going forward, we're going to see more discrimination when it comes to earnings. How sustainable are those, looking at different pockets? So we think, software, cloud computing, those are going to be the key areas of focus. But I think it all comes down to, tech sector overall in Q3 posted almost 30% year-on-year earnings. We think that momentum can persist, backed by the CapEx. I mean, if we look at U.S. CapEx as a share of overall CapEx, AI is around 38%, whereas if we look at developed markets ex-U.S., it's about 1%. EM is about 16%. That's a significant differentiation. We think that CapEx will translate into meaningful earnings, and that's going to be an underpinning of that AI tech trade, but selectively on those that can prove profitability and the returns on investment from that spending.
Yeah, so that's interesting, Laura. So does that mean the rest of the world has some catch-up to do when it comes to CapEx on AI? Or will possibly this will just be left to the hyperscalers in the United States? Or maybe with the geopolitical tensions in play, maybe not?
Well, I think it's leaning into the strengths of each of the different regions. We certainly saw growth outperform in the U.S., but we're seeing values start to outperform in Europe as well. And I think there is a meaningful case for European equities if you want to bet on some of this growth, this cyclical upturn more globally. We think that Europe is well positioned. We've clearly seen European banks strongly outperform. European banks are cheaper relative to the U.S. And if we think about this backdrop of the fiscal impulse, the rate cuts that we have seen from the ECB, activity that's starting to meaningfully transmit through the credit impulse, and as well this overall infrastructure and defense spending coming from Germany. All of those factors does suggest this need for diversification, or really more of a barbell, taking on that AI exposure in the U.S. and looking for those regional opportunities elsewhere.
Yeah, it's interesting that since the start of this year, Asia has done really, really well. We started the program talking about this earlier. Then, actually, in terms of the major regions, then Europe, then the US. And we had a guest on earlier this week who was saying that perhaps US-based investors have not been cognizant enough of the gains that have been made already outside the United States. Sounds like you're leaning more into the US theme, though.
I think because we saw that S&P 500 underperformance really relative to most of the major stock indices last year, it does suggest that there is going to be a bit more of a rotation towards the U.S. and not just that AI trade. I mean, if we look at one of the dominant themes to end 2025, we started to see investors rotate elsewhere. And so we think this is going to be a broadening bull market in 2026. So not as concentrated, I would say, in the AI gains in 2026. And that's going to open up this opportunity set for U.S. investors in the U.S., but as well maintaining that regional global diversification.
Why do I want to buy expensive U.S. stocks when I can buy stocks in Asia that are much cheaper? And yeah, I hear what you're saying about the AI build-out. But the AI build-out's using components from Asia. Like, a lot of them come from there into the United States. It's not like they're built in the United States.
Well, and I think the valuation argument is certainly one that's worth monitoring, but we think investors are paying a premium to capture that secular AI theme that's going to pay off in the medium term. Whereas if we look at some of the Asian economies, they have performed well in terms of the tech, but they are more exposed to geopolitical risks, some of those supply chain disruptions. So we think investors, it leans into our story for 2026 around that diversification, but we think there's still a premium that's worth paying up for U.S. large
You said
caps.
Medium term. Does AI need to deliver this year? Do I need to start seeing tangible effects, monetizable effects of AI this year for this thing to carry on?
And I do think that's kind of the key risk going forward, right? Investors may have kind of this valuation fatigue. They're continuing to pay these premiums that we may not see those returns. But as I mentioned, looking at the earnings backdrop, I mean, even looking at the S&P 500 overall, including tech, we're expected to see anywhere from 10 to 12% earnings this year. That's continuing on this robust period of these gains. We think that can be sustained, even if we do see that slowing overall in tech. So these companies are showing kind of the signs of those profitability gains coming through. Maybe we need to see that a bit more materially. But when we think about the AI trade, AI is both the physical layer and as well it's the digital layer. So for investors, it's about barbelling between the two. You want moving on that. One is a fast-moving cycle. It's very earnings-led, sentiment-driven. You want to have that U.S. equity exposure. But I think importantly, investors will increasingly look at that physical layer, the second-order effects, financing the build-out of AI. Those tend to be more long-duration, contracted cash flows, inflation-linked. We think that's probably the greater opportunity set there, while still maintaining that U.S. equity exposure in tech.
Do you think we start to see similar credit dynamics in Europe in terms of the fund for the build-out of AI?
I think we are starting to see that overall, but I think that the key focus for us is looking at that infrastructure and defense spending. We think that's going to be a key pillar of growth overall in Europe. So that's going to support even more of the defense companies, the industrials, the banks, and even some of the luxury sectors. I mean, it's not tied to AI, but I think it's just leaning into overall the upswing that we are expecting in overall global growth. I mean, not certainly kind of shooting the lights out in terms of global growth.
But luxury names come back in 2020 despite China?
Yes, at the margin, we are leaning more into that. I mean, we are seeing still a healthy consumer, healthy labor market overall in Europe. We are seeing real incomes continue to rise. And the backdrop where we think, inflation is really at the 2% target, we think that's a meaningful backdrop to have greater exposure to some of those cyclical components in Europe.
Okay, and you think then that in Germany, if we get the level of spending and the speed of spending that's planned, you think that we might end up with a rate hike in the Eurozone by the end of this year? Is that?
It's been a bit of an out of consensus call, admittedly, but we do think against this backdrop where inflation has shown it's settling around that 2%. I mean, in the near term, we could see price pressures dip below that 2% target. But overall, looking at inflation expectations, underlying inflation, we think inflation is relatively contained. And so if we start to see more of this fiscal impulse come through, we think that's going to be meaningful enough to boost growth in Europe to about 1.3% this year. And again, we think that's going to be sufficient to withdraw some of this monetary easing.
I wonder if it depends who leads the ECB, Guy. Maybe she says she's out of consensus, Laura, but maybe Isabel Schnabel's on the same page about the rate hikes.
Rate hikes, yeah. I think she sort of toned it down a little bit, but yeah, there is this kind of overlying. What brings all this enthusiasm to an end? The bubble talk at the end of last year was everywhere. It seems to have calmed down a little bit at the beginning of this year. As we work our way through 2026, do we get to cycle highs in 26? What ends equity enthusiasm? Is it just a mechanical process? Money just keeps getting shoveled into these markets, and therefore markets continue to go higher. What is it that you see on the horizon that will start to slow things down? At some point, we are going to see rate hikes. May start in Australia, may come to the ECB. At some point, the Fed's going to be on that narrative as well. Probably not in 26, maybe 2027. Is this a year that I need to be thinking about transitioning to a new paradigm? It feels like we're coming out of 25 with the same paradigm as we're going into 2026. But how do I think about the year ahead? How kind of early in that process do I need to be? Being early is dangerous. But being late's also dangerous. So how do I kind of finesse this one?
I think it's a really important question because a key trend that we saw in the latter part of last year was investors shifting away from that monetary easing story persisting to one where they were starting to price in rate hikes, whether that was Australia, whether that was Canada, whether clearly Bank of Japan. But that was really the dominant theme in G10. I feel like that's kind of gone under the radar more recently. So I don't think, to your point, that's going to be a meaningful story, certainly in the first half of 2026. I think we can continue to see Fed rate cuts coming through. We have 2 cuts penciled in. We're going to see strong growth come through in the U.S. from tax cuts, from fiscal stimulus. So I think all of those factors suggest that maybe we can continue to grind higher, to your point, to cycle highs. Geopolitical tensions at the margin, I think, are increased in terms of their risk for this year. But we need to see more sustained shock in terms of like an oil price transmission mechanism. But maybe perhaps looking at fiscal deficits. Investors clearly don't have that on their radar. I mean, that's obviously not a clear risk for us at this juncture. But I think it's going to come back on the radar. And one of our key themes in our investment outlook is that fiscal policy will matter more for markets than monetary policy this year. And I think we're going to see that maybe paradigm shift going forward.
Nice to see you, Laura. Thanks for stopping by to see us at the beginning of 2026. Looks like it's going to be an interesting year. Laura Cooper, Global Investment Strategist, the head of macro credit at Nuveen. Take a look at what is happening with Novo Nordisk. So this is today. Okay, so it's up by 4.5% today. It was up by, I think, circa 5% yesterday. On a 2-day basis, and I just made sure I was checking this, we're up by 9.6, nearly 10% on Novo Nordisk in 2 sessions. It's launched its obesity pill in the United States. There's also a pricing factor around that as well. The market seems to be absolutely loving this. Obviously, a tough time back end of 2025, obviously with the whole M&A story, but it seems to have surged into 2026, as I say, up by nearly 9.6%. Everything else is red. And it's interesting to see some of the defence names turning over a little bit. ASML also turning over a little bit. It's had a cracking few days, but it's showing some signs of weakness this morning as well. Let's start with those chip stocks and go over to Chloe Melee.
Good morning, Guy. Indeed, we are seeing some positive movements, some green across the screen here for chip makers, and that it follows a kind of broader AI enthusiasm. But we also had a microchip over in the US boosting its forecast. And for names in Europe that are really exposed to that auto and industrial end markets, we're thinking particularly of Infineon and ST Micro. That is some positive read across, and therefore we are seeing those 2 stocks in particular move about 2% this morning. Moving on to InPost, which is a Polish logistics firm. It said that it had received an indicative proposal for the potential acquisition of all the shares in that firm. And so we are seeing a really impressive move this morning for that company, and we are up almost 18% at the open. Moving on to Adidas, and there we are seeing some weakness. Adidas was double downgraded by Bank of America, analysts saying that the company will see lower growth going forward, and that investor interest in that sector was waning. And we are seeing quite a lot of weakness in those shares this morning were down about 5.7% for Adidas. And finally, Ocado was placed on positive catalyst watch by JP Morgan analysts, saying that fundamentals were improving for the company. It would see more operational stability after quite a lot of setbacks, including the biggest U.S. customer Kroger pulling some of those sites, closing some of those sites operated by Ocado. But it seems that now the company might be back on track, and we are up 6.4% this morning.
Thanks, Chloe. Equities reporter Chloe Melly. And sticking with the retail theme, Next shares are moving higher this morning. More on what's fueling the optimism behind that retailer, giving us an early take of how things have gone for UK retail, perhaps, over the holiday period. More on that next. This is Bloomberg.
Tuesday morning, good morning, 18 minutes past the hour. This is what the markets look like, let's call it 19 minutes past the hour. Actually fading a little bit, not quite maybe so positive as they first looked first thing this morning, as we see some of the continental markets beginning to drift off a little bit. The London market's having a slightly better day. There's some interesting stock stories out there that are definitely worth focusing on. Novo Nordisk is one of those, Adidas is another one of those. The chip story is beginning to fade a little bit, which is interesting after some really positive performances that we've seen so far this year. But a more muted session maybe beginning to emerge here in Europe.
Yes, indeed. And one thing that's not been muted, though, has been the performance of the Next share price. UK Retailer Next has raised its profit forecast for a fifth time this financial year after sales rose more than expected over Christmas. Let us speak now to Bloomberg's global business reporter Jennifer Creary, who's got details here. Now, Next seem to be masters of this kind of under-promise and over-deliver and raise their expectations. So let's talk about what this result means. Tell us about the results and how this sector has fared over Christmas.
Exactly. So this is very characteristic of Next to consistently upgrade its pre-tax profit guidance. So now it's expecting pre-tax profit of almost 1.2 billion, and it's worth noting that a lot of this growth is coming from overseas, so less so in the UK. So overseas sales up 39% over the Christmas period, UK sales up 6%. So that's really giving investors confidence that the company's on the right track, but perhaps more of a muted picture for the UK retail scene. Consumption still down. Next also warning that that sales and profits are expected to grow at a slower pace next year. So perhaps, a strong Christmas season for Next, but perhaps not stellar.
Yeah.
So the picture for the UK is not quite so good. 6% doesn't sound quite so positive. And that sounds okay relative to the rest of the sector. Wolfson continues, Lord Wolfson continues to kind of bang on about his concerns about the UK. Do these numbers kind of justify that? He's doing well internationally, but he's not doing well domestically. So what is the picture in the UK broadly?
Yeah, so CEO Simon Wolfson has said for a while that the UK consumption landscape is going to be pretty muted, and he's blaming that on various factors, rising employment costs, higher national minimum wage, and that's really affecting how much consumers are willing to spend. One other data point that came out overnight was BRC figures, British Retail Consortium figures, that showed that while non-food inflation was down 0.6% in December, for food inflation that was up for the first time since August. It's up 3.3%. So it's going to show that for the high streets, supermarkets are really bearing the brunt of a lot of those cost pressures.
Interest rates, arguably interest rates will start to have a broader impact, so that takes a bit of time. Cuts have come through. Maybe we get another 1 to 2 cuts from the BOE this year. What is the outlook looking like for the UK consumer then at this point?
Yeah, so it's a bit of a mixed bag. So the BRC is warning that in 2026, food inflation will remain quote-unquote sticky. And also, of course, Next saying that consumption is meant to be more muted in 2026. So it's a bit of a mixed picture. So later on this week, we'll have a couple more trading updates. We've got the UK's biggest supermarket, Tesco, giving an update, and also Marks & Spencer, arguably Next's biggest competitor. So we'll get a better sense of the state of play later this week.
Yeah, and there was a line in our reporting about next benefiting actually from the cyber attack on M&S. So we'll get the M&S update later this week alongside Tesco's as well. Jennifer, thank you very much indeed. A touch there in terms of the health of the UK consumer with Next coming in with a stronger than expected print and an upgrade in terms of the forecasts. Despite the challenges here in the UK economy, Bloomberg's Jennifer Creary breaking the numbers down for us. Let's get back to the tech story, the AI story, of course. Nvidia CEO Jen-Hsun Huang saying that the company's highly anticipated new AI chips are nearing release. Speaking at CES in Las Vegas, Huang said customers will soon be able to try the Rubin semiconductors, which are expected to speed up AI development.
Today, I can tell you that Vera Rubin is in full production. This is a Rubin pod, 1,152 GPUs in 16 racks. Each one of the racks, as you know, has 72 Vera Rubin, or 72 Rubins. Each one of the Rubins is 2 actual GPU dies connected together. So this is it. This is Nvidia today. You know, we mentioned that we build chips, but as you know, Nvidia builds entire systems now. And AI is a full stack. We're reinventing AI across everything from chips to infrastructure to models to applications. And our job is to create the entire stack so that all of you could create incredible applications.
Nvidia CEO Jen-Hsun Huang, and of course Guy Johnson's been obsessed by Jensen's new shiny jacket. But as well, it's the full stack that I think is really important from that soundbite that we heard from Jen-Hsun Huang, emphasising that they're not just playing in terms of the chip space, but the networking as well, and that they're starting to see a push beyond the chatbots into enterprise. There's been a lot of push around sovereign AI. Jen-Hsun Huang's been leading that. This year, it seems, it's consumer hardware, it's robotics, and it's enterprise and partnerships with companies like Siemens.
It was Anna, not me.
Who was obsessed with the jacket? I was. And now the team's just planted the idea of what costs more, the jacket or the array behind him. I'm sure it's the array behind him, but I don't know where the jacket's from, so who knows?
Yeah, I suspect somewhere very expensive. It looks very expensive. But the interesting story here is the fact that, yes, the emphasis was on chips, but he's talking about it being a networking company now. He very much kind of sees it as that narrative. But he was also pushing the idea that this is a robotics company too. And that really is where he sees the future now coming. This is what he had to say when it comes to the robotics story, particularly when it comes to autonomous driving and all those kinds of stories that we're working towards.
Mayo does something that's really special. Not only does it take sensor input and activates steering wheel, brakes and acceleration, it also reasons about what action it is about to take. It tells you what action it's going to take, the reasons by which it came about that action, and then, of course, the trajectory. All of these are coupled directly and trained very specifically by a large combination of human-trained and as well as Cosmos-generated data.
Is it going to be good enough, though, to do autonomous driving? Or is it just going to be kind of make all the aids that we get used to now better? Are we actually at the point where this stuff can be trained to deliver real world situations that will allow autonomous driving?
This stuff seems, the things that Jensen is talking about there, the product from Nvidia seems to not be at the same level of autonomy as we see from other players who are already on the roads. And Jensen saying his product will be on the roads in the first quarter in the United States. They're kind of catching up, but who knows who wins in the end.
And it is a gradient to the point in terms of where we get to fully autonomous. That's not happening this year. Of course, if you're living in San Francisco, you're very used to getting into Waymo. Waymo comes to London this year. Wave AI, which is based in London, starts this year to roll out as well. So this is a pivotal year in terms of the gradient towards more autonomous vehicles, and Nvidia wants to play that place.
And later today, Bloomberg's Ed Ludlow will be sitting down with Nvidia's Jen-Hsun Huang, who will appear on stage at the CES with the Siemens CEO, Roland Busch. So that conversation will be later. This is Bloomberg.
This is the opening trade, 30 minutes then into today's session, building on the strong gains that came through for European stocks yesterday, of course, up 0.2% so far across the benchmark. A bit of divergence, though, when it comes to the UK, the performance of the FTSE 100 versus its European counterparts. A little bit of pressure over in France. The CAC 40 down 0.2%. A little bit of softness in the DAX as well, off by 26 points. Of course, the defence names that came through very strongly yesterday, you're not seeing similar gains in that sector today. Next, and the next effect is being felt, the FTSE 100 up 0.5%. Guy.
Let's talk about where we are in terms of the internals. Volume's actually a little bit light, which is interesting after a strong start yesterday. Reasonably balanced in terms of the up and down. 281 up, 216 down, so a slight bias to the upside, but not really by much. Let's talk about some of the single stocks, though, because this is where life gets really interesting, I think. Novo Nordisk, really strong two-day performance for the Danish company. As you can see, it's up by nearly 5% today. Similar numbers being generated yesterday. It's up by circa 9% over 2 sessions. Launching the pill, weight loss pill in the United States, plus kind of pricing it aggressively. The market seems to really like this, and the stock is absolutely flying on the back of this. Yesterday, we saw actually some of the Swiss names, particularly in the pharma space, down. We're reversing some of that. The banks are also doing relatively well as well. HSBC is emblematic of that. It's up by 1.1% this morning and doing relatively well. Similar story to what we saw last year. The tech story is really interesting here in Europe this morning. SAP is down by 1.6%. ASML is also fading after a strong start. It's beginning to get back some of that sort of early chip ground. So that sort of software chip divergence is beginning to fade a little bit, maybe. And three stripes and you're out, apparently. Adidas down by 7.36% this morning. We've got a double downgrade coming through from Bank of America. And Adidas does not like that in terms of the stock performance, as you can see, down by 7.3%, as I say, Anna.
Yeah, absolutely. Weighing on the sector. Let's get an update on some of the other news flow that we need to cover for you this morning. Delcy Rodríguez has been sworn in as acting president of Venezuela after the capture of Nicolás Maduro, flashing warning signs that a new wave of repression has begun. At least 7 journalists and members of the press were detained on Monday. This while in the United States, Nicolás Maduro pleaded not guilty to narco-terrorism charges in a New York court. The French President Emmanuel Macron will host Ukraine's allies in Europe and the United States for talks today in the hope of finalising a security agreement which could see American boots on the ground after the end of the conflict with Russia. The Ukrainian President Volodymyr Zelensky says the focus of the talks will be on post-war recovery as well as US security guarantees, and that the discussions could last a day or two. China has imposed export controls on all dual-use items to Japan for military purposes. The country's commerce ministry says the move is to safeguard national security. The new ban intensifies a dispute between Asia's 2 largest economies over remarks Japanese Prime Minister Sanae Takaichi made on Taiwan last year. Tom.
OK, let's get to the public markets and deal activity as we think about just how much catalyst there will be for this year. Taking a company public is usually the culmination, of course, of years of effort to ready a privately held firm to sell shares for the first time. Stock exchanges are now pulling out the stops to make the first day of trading a day to remember. Let's take a look at what they are up to.
An IPO is often the pinnacle of success for executives. There are speeches, hugs, even tears.
I achieved my dream.
The champagne and confetti and countdown clocks might look like a nice party, but it's serious business too. Listings have been dwindling in recent years in the aftermath of COVID and rate hikes to tackle inflation. Exchanges have been competing for a shrinking slice of that pie, and a good show is part of the marketing.
Part of getting the message out is a way that we effectively live the stories that the companies execute through the medium of an exchange. And yes, of course, it reaches out to companies which may be within an IPO pipeline.
Asia has dominated listings for the last few years, and its listing ceremonies mix tradition with pomp and some fun. In Hong Kong, there are gongs of different sizes.
So there's the standard size gong. We also have a bigger gong or a mega gong. That's for very special and larger companies listing Hong Kong.
So, little surprise then that when China's CATL sold shares in May, raising a whopping $5.3 billion, no ordinary ceremony would do for the world's biggest maker of EV batteries. The Hong Kong Exchange wheeled out its mega gong. With CATL shares handily beating global benchmarks since the listing, fortune has indeed been kind to the company. As Europe and the US look to rival Asia by claiming more new listings, the pizzazz, showmanship and company mascots show no signs of being canned as trading gets underway.
Well, let's stay on the theme of IPOs and deal-making and bring in Matthew Wiltz, EMEA co-CEO at JP Morgan. Matthew, thank you for joining us. I believe you and the team are on the road now, pre-Davos tour, talking to clients, talking to customers, talking to the team. What is the mood, Matthew, when it comes to deal-making prospects in 2026?
Thank you, Tom, and thanks, Anna and Guy, as well, for having me this morning. So, clearly, let's say the sentiment is positive, and we see the pipeline that we have both in M&A and in IPO is very robust. We had a very strong year last year outside of the, let's say, 3 months post-tariff announcement. But since the month of August, we see another peak of activity, and we think that 2026 should be a good year for IPO again. There is strong demand from the market. When we listen to clients as well, there is a real willingness to come to the market and benefit from that window. As you said as well, we are in the middle of doing a European tour. So with some of my partners, we are traveling across Europe this week and Middle East next week. Trying to be with clients on the early part of this year as well, and make sure that we stay close to them, we listen to them, and we try to help them to navigate into that difficult geopolitical landscape. Markets are doing well, but clearly the geopolitical points are clearly more difficult to anticipate and navigate. But we are bullish, to your question, clearly, on our capacity to deliver more IPO this year.
Well, Matthew, you bring in the geopolitics, so let's go there. And of course, the unprecedented events in Venezuela. Has that changed the view, the team's view, the House view? How are you thinking about that in terms of the impact, the economic impact, the risk impact, maybe the impact on deal making as well? Has it adjusted your outlook for 2026 at all?
So this one is difficult to assess right now. That just happened. We see that when we look at the market and the performance of the market yesterday, equities did perform pretty well. We look at the issuance as well, because we expect a strong January as well for issuance. Just yesterday in the US, we issued more than 61 billion of bonds, not JP Morgan only, but the markets as a whole. And credit spread are doing extremely well, even if those volumes are impressive. When we look at the Brent, yesterday was relatively stable. We have a target at $58 for the end of 2026, so decrease from where we are at the moment. But clearly that was pre-Venezuela. We have to reassess. We are looking at that with our research team. We don't expect, based on the market reaction, any significant drop. Now, when we analyze the situation, everything will depend on how strong the US will be into the day-to-day politics in Venezuela. Because if you look at it, Venezuela is one of the biggest producers. So if you take Venezuela plus the US plus part of Guyana as well, that means that if the US are really driving that, they're going to potentially influence 30% of the crude production. So that definitely will have an impact, but it's very early stage and difficult to assess for the moment. But that's something that we monitor every minute now.
Okay, good morning to you, Matthew. So the geopolitical situation very much in flux, under review, as you describe it. Clearly the fiscal impulse here in Europe, thinking about your EMEA geography, the fiscal impulse is certainly an area of focus. And I noticed that you are opening a new digital bank in Germany this year. I wonder what your hopes and dreams are for that fiscal push in Europe and what it can deliver for banks and for JP Morgan.
So I think that, and I'm a European citizen. I've been at JP for 25 years, but I've been always in Europe, and I'm a strong believer in Europe and the fact that we can do more. When we listen to the Draghi report, and we are definitely 100% aligned to what has been offered and proposed, we think that with more cooperation, more alignment, stronger leader in Europe, Europe can do better. And we live in a world where now economically we have to fight against the US, Asia, part of the Middle East as well. So I think Europe getting together is definitely a must. So And you could think that it's counterintuitive for a US bank to say that, because you could think that we would benefit from more, let's say, fragmentation in Europe, but this is completely wrong. And Jamie Dimon has been very vocal about it as well. Having a strong Europe, having more cooperation, having stronger leaders, but that means that in Europe, every country needs to accept that they may win in one industry if we have more M&A, and maybe France will have more finance or automaker or healthcare. Maybe Germany will do something else, or Italy or the Netherlands. But we need to make sure that like authorities and companies are allowed to for M&A and cross-border activity. And if we have stronger players in Europe, that's going to be the only way that we're going to be influential, let's say, globally against the big player in the other regions.
And Mathieu, one of the areas where many have been trying to craft some cross-border M&A has been within the banking sector. We heard from a European commissioner recently, Mathieu, who was saying that actually it is US banks that manage to navigate the fragmented banking landscape across Europe better than perhaps the European ones do, because they are partly because they are outsiders. I mean, does that chime with your experience? Do you find, as Americans in Europe, it's relatively easier to navigate that fragmented banking landscape?
I would not say that. I think that when we talk to clients, and I think most of the feedback that we receive from clients is like several of the American banks, and JP Morgan being the first one, we've been consistent and we deliver like very strong support and services. Even during volatile periods, during global financial crisis, during COVID, we were always there, and we never scaled back from our positions. And we have that role across all countries in Europe. The issue that we see in Europe for some of the European players is like, it's very hard for them to be strong in every country. Many of them are very strong in their country, but it's very hard to have a presence and to be a leader in every country. And that's why we think that we need more M&A, and we need for Europe to have stronger player and cross-country player. So you could see that in a way that would go against our position and maybe against our market share. But we think that having stronger leader at the end will increase the wallet and will be better for the business overall for Europe. And as JP Morgan, in that current environment, we think that we would be alongside some of the strong European banks, having, let's say, most of the market share and do a good business in that environment. So that's why we are so pushy for more consolidation and more cross-border M&A in Europe as a whole.
Yep. Mathieu, good morning. It's Guy. Couple of questions on the credit market. How much of what you guys are going to do this year is going to be data center origination in credit? How different does the market in Europe look compared with the United States or Asia? What is the story here in Europe when it comes to that segment of the market?
So, I mean, clearly it's been a big theme last year, both in Europe and in the US. But AI, data center financing, we've done a lot. There is strong needs as well, also in AI for CapEx expenditure. That's one place that we like. We want to continue to do business. I know that there is some noise about the fact that we could have a bit of a, let's say, boom at some point in the area. That's why we need to be cautious as well. And I think that's the nature of our business, is to be with clients, alongside them, and give them liquidity when they need to do investments, capital expenditure, but also make sure that we choose the right partner. And I think that based on our experience, because we've been in the credit market for more than 200 years, from private to public, we have that experience. And I think that's the benefit as well for clients who work with partners like JP Morgan, is that we can deliver on the whole range of products. If you want to do private and more private transaction with like very different set of investors, we can deliver on that. If you want to do more public transaction, broadly syndicated, we can deliver on that. And we have the experience, and that's why we are trying to demonstrate, because that market is changing with newcomers as well. So we have to fight to protect our market share for sure.
I'm getting the sense here that maybe you think that some people aren't being careful enough in this space. Clearly, these are not JP Morgan clients, of course not. But do you think there are others that maybe aren't being quite as doing their due diligence as well as they should, maybe?
I think it's maybe, I mean, for sure, and we see that every day in the market. We are not trying to hide as well, and I think when we published our results a quarter ago, I think Jamie has been very open as well and transparent about the situation we had with Tricolor in the US. So I'm not trying to hide, and I think issues can happen to everyone. I think that was also a good reminder that for all of us internally, that we need to stay highly focused. We need to double check on everything. I think we live in a market today where there is an excess of liquidity offered to the market overall. So that's why we need sometimes to refuse to do transaction if we think that especially covenants are not there and do not give us enough comfort. There is also a big change is that more and more co-investors are coming with us or with some of the private credit players. So we were already doing it for us, but having co-investors, that put even more pressure on us to make sure that we do the right due diligence and that we do invest and lend only where we are 100% comfortable.
Okay, scrutinising the covenants. A year, of course, expected to see strong demand for IPOs and M&A. Really appreciate the time. Matthew Wiltz, JP Morgan's co-CEO of EMEA, with a view on the private credit space as well and how that ties into the demand around data centre build-out. Matthew, thank you. Coming up, how much return has Michael Platt's firm, Bluecrest Capital, added since he ditched clients to trade his own money back in 2016? The answer when we come back. This is Bloomberg. Welcome back. Now, before the break, we asked how much return has Michael Platt's firm, Bluecrest Capital, added since he ditched clients to trade his own money back in 2016. We can reveal the answer. Just a mere 7,858%. That is a gain on the Bloomberg calculations again since 2016. According to sources, the firm gained 73% just last year. A lot of those gains coming in the early months of 2025 when, of course, President Trump's tariff announcements sent markets haywire. Didn't have to deal with redemptions and client pressure, of course, trading his own money. Bluecrest's track record offering a rare glimpse then of how managers can perform when they remove some of those constraints outside capital. Not a bad print over that number of years since 2016 and gains of 73% just last year alone. Guy.
They've got skills. Definitely give them that. That's a big number. That's a very impressive number. I'm not sure how I transition from that to this, but I'm going to do it anyway. The French president this morning, we've seen some pictures already as the Elysee hosting European leaders and US officials for talks today. The hope is that they will finalise a security agreement, I can't talk, which could see American boots on the ground in Ukraine after the end of the conflict with Russia. We're joined now by our global defence editor, Jerry Doyle, to talk about this. The situation is evolving, not just in Ukraine, where we're watching the situation very carefully, but you've now had Venezuela to kind of fold in what Trump has done there and his threats regarding Ukraine. And they all interact and they all have an impact on each other. And I'm wondering how the situation in Venezuela and Greenland is affecting Ukraine.
As with anything that happens with Trump and the U.S. military at the moment, it's impossible to say, I think, definitively what the impact is going to be. But broadly, if the U.S. is considering or discussing or proposing to its European allies putting American troops on the ground or providing intelligence or satellites or other means of sort of protecting Ukrainian sovereignty after there's a peace plan, the actions in Venezuela, which seem to have been done unilaterally, and of course the threats against Greenland to take it by force if necessary from a NATO ally, certainly seem to undermine perhaps the credibility of the U.S. acting in concert with European allies to protect Ukraine when it seems willing to sort of openly propose threatening another NATO member over its own territory.
Yeah, it would seem to perhaps undermine the spirit of cooperation that effort would require. So Jeremy, and how seriously should we take then President Trump's calls for the need to control Greenland? Is something he's returned to. He's appointed somebody to run this from Louisiana and to look at it very seriously, prompting the leadership in Denmark to make some really bold calls about what this will mean for the future of NATO.
Indeed. I mean, the Danish government said outright an attack on Greenland would mean the end of NATO. And indeed, NATO doesn't have any provision baked into it for one member attacking another. It's not something that was ever considered, because the genesis of NATO was, of course, to provide a backstop, a force to counteract the Soviet Union during the depths of the Cold War. Now, the U.S. already has a base in Greenland, Patuxent Space Base. Apologies if I mispronounced the name there. It's a Space Force base, and it's been there in various forms for a long time. What the U.S. wants outside of that is not clear. How far Trump is willing to go to obtain that is also not clear. But clearly the rhetoric that's happening right now is causing a lot of instability with U.S. allies.
Okay, Jerry Doyle. Yeah, he gave a 20 days. Was it 20 days? Come back to me in 20 days, President Trump said when it comes to the question of Greenland, but reiterated that the US, quote, needs Greenland. And they had a response from the Danish Prime Minister, of course, yesterday. Jerry Doyle, our global defence editor, with some of the implications of that remarkable posture being taken by, of course, the White House right now. Here's what else to think about then across today. Zelensky then, the meeting, as we discussed, with US and European leaders in Paris. That is currently happening. Of course, we know that the Canadian leader is there as well, Mark Carney, along with others, to discuss those security guarantees and trying to nail down the commitments from the US. Later this morning, European and UK final PMIs. At 1 p.m. UK time, we're going to get German CPI. And at 1 p.m. as well, UK, and at the same time, we're going to get the Fed's Barkin's going to be speaking on a week, of course, when we get more detail in terms of the labour market of the US, with job openings on Wednesday, tomorrow, and then non-farm payrolls, of course.
And, of course, a helping of tech with CES in progress. Let's talk about these markets. Valerie Teitel is with us once again to close out this hour of programming. Valerie, we have spoken to guests who say that the conversation around the Fed is not going to be as important as the fiscal narrative this year. I wonder how that sits with you, thinking about the Fed speakers we've got coming up.
Look, I think that could be a very true. If we get unemployment ticking back down to 4.5% on Friday, that could really cement the Fed being on pause until the new Fed chair gets in around May, and we have that June decision. So we could be looking at the first half of this year where essentially monetary policy isn't really in the front seat for markets. It's all about AI. It's all about fiscal spending on a global scale. Germany, Japan, and the U.S. Leading markets instead of the Fed. Now, if we look at what's priced in, we really don't have a lot priced in for January. But if we do get a non-contentious non-farm payroll report on Friday, I think you start to get markets contemplating a Fed really on pause until the summer.
The message from the commodity market is inflation's coming. Is that what we should read into copper this morning?
Well, I mean, we will get the inflation print, the consumer price inflation print next Tuesday. Now, seeing how inflation is going to be feeding into these markets, I think it's really more down to tariff-induced inflation and whether that's behind us rather than commodity-induced inflation. I know you're smirking at me. But I do think that there will be a moment when the market does decide that tariff-induced inflation is done with. That is the risk, I think, here for seeing a decent bond rally, for seeing downgrades to inflation expectations when it comes to 2026 and perhaps opening up the door for more Fed easing. That, to me, is kind of the risk scenario of where we could be headed, not necessarily the base case for markets.
The risk scenario, because the markets may decide that the tariff impact is done when maybe the tariff impact has shored up prices at a certain level, or that they've been stored up and they come through later in the year. Is that... that's the risk on the tariff story.
I mean, so what we definitely have had some inflation impact when it comes to tariff already. It's just whether the market is going to decide all at once that perhaps there's no more to come. I think that we've had many economists kind of push out their expectations for when it might come. Those who are worried about inflation say that it still has a few months to come in, but it could be a snap decision in the market all of a sudden when we decide that that's not a risk for 2026.
Valerie, thank you very much. Valerie Teitel, our markets reporter. Lots of tech to come. Bloomberg's Ed Ludlow will sit down with Nvidia's Jen-Hsun Huang. That is later on in programming. Don't miss that. This is Bloomberg.